Hey, if you're a storage unit facility developer and you are looking to raise capital from investors and lenders to get your project off the ground, you're probably going to need to create a set of financial projections to present to the bank or to potential investors. And if that's the case, then you've come to the right place because we've built a financial projection template built specifically for self-storage developers. And I'm going to walk through how this template works, how to fill it out. I'm going to first kind of go through just at a really high level and kind of show you what's included in the template so you can get a feel for everything that's here and included before watching the whole thing, because there's quite a bit of detail in the model. And so I'm going to give you the high level overview first, and then I'll go back in and dig into the details. But before I do that, just a little bit of background. My name's Adam Huxema. I'm the co-founder of Projection Hub. And over the last decade, we've helped over 50,000 entrepreneurs create financial projections for potential investors and lenders. And today we're specifically focused on this self-storage developer template. And I'm going to now walk through how it works. Okay, so we are starting on our at a glance tab here. And this is kind of once you've filled everything out, you'll get to see your cash flows at a glance. And this is a 10-year financial model, so you'll get 10 years of all of this data. You get some different key ratios, some summary data, some graphs and charts that you can put in a pitch deck or a business plan to present to funders. You will also get your 10-year cash flow statement here, a 10-year balance sheet summary. So you've got a 10-year balance sheet, and then a 10-year income statement summary. And then you'll get the cash flow statement, balance sheet, and income statement all broken down by month for all 10 years. So you get that monthly level detail. If you really want to dig into the weeds and see that monthly level detail, you have that ability as well. Now, that's kind of the report side of things. There are a number of input tabs where we need to input assumptions. I'll go over those at a high level here. So you can enter in your unit mix here. So you're going to have, maybe small, medium, and large storage units. How many are you going to have? What size will they be? What annual rent per square foot will you charge? When will the construction be completed? How long will it take you to get those rented out? All of those sorts of assumptions. What's your annual rent increase going to look like, and your vacancy rates here? All of this will allow you to forecast your gross potential income, and then vacancy and credit losses, and then ultimately your effective gross income. Once you have that, you can also forecast your operating expenses. And all these operating expenses can be projected on a per unit, per square foot, or an entire property basis, as well as expenses as a percentage of revenue. And then you can also, if you'd like to put in, if you're going to have salary positions at the facility, for example, you do have the ability to put in salary positions if you'd like as well. Now, all of this is going to allow you, once you have your revenue and your expenses, you'll be able to forecast your net operating income for the facility. Once you have your net operating income, and we can see here that the model and all the assumptions that I've got in here as a default is assuming or is forecasting a net operating income once the property is stabilized of $24,702. And so if we say, hey, our bank is asking for a 1.25 debt service coverage ratio, we can use that to then forecast, okay, what's the maximum monthly loan payment we can afford? Well, with the 1.25 debt service coverage ratio and this net operating income, we can afford $19,761 in debt service. If we assume a 6% interest rate over 30 years, we can kind of back into the number of, okay, how much of a loan can we actually qualify for here? And so based on those numbers, we're able to get just under 3.3 million in loan funding. Now, if we say our target debt to equity ratio is 3 to 1, that means we'll be looking to raise around 1 million in equity. And so then you can see you'll actually then be able to enter in your equity sources. And so let's say we put in actually $1 million in equity, and then down here we've got our construction loan at 3 million. The model allows you to refinance the construction debt because you'll have construction debt initially, and then you'll probably move to maybe mini perm and then permanent debt over time. And as you refinance, you'll likely get better interest rates over time as well. And so all of this kind of comes together to determine what's your total budget to play around with here. So how much cash you have available to actually build the structure. And so we kind of back into that, and we say, okay, we've got $4 million to play with between our debt and our equity. Now let's fill out our construction budget. And so you can enter in construction budget assumptions here as well. And then ultimately, this kind of gets us to our input distributions tab. This is a way to model what an investor might be able to expect at a very high level. So we're not getting into more complex like waterfall scenarios. For investors, this is just kind of at a high level. If you need something more customized, you can reach out to us on that. But what this allows us to do is say, take our cash flows, and we can decide how much of our cash we want to disperse or distribute to investors. And then we can enter in some sale assumptions. So we're saying, okay, we're going to sell the property in year 10 at a 6 cap. And once the debt's paid off, we're going to have net sale proceeds of $3.4 million. That, along with the distributions that the investors are getting along the way, this property, based on all of our assumptions, is going to have an IRR here of 20.03%. And you can see some other investor returns like cash on cash returns as well. So that's kind of at the high level what we're trying to get at. So it allows us to, one, kind of model out what a potential investor can do, and secondly, model out what we can expect to qualify for in a loan from a bank. Now, this is a pretty complex model, and so you might be thinking, hey, I don't need something this complex. I just want something really high level. We do have what we call our simple self-storage unit model. It's a much more straightforward template. It's not as sophisticated, and probably if you're trying to raise millions of dollars from investors and lenders, you might need something like this. But if you want something more just quick and high level, there is a link in the description of the video below to that simple self-storage unit model. So you can take a look at that as well. Okay, with that, I'm going to go ahead and dive back into the input tabs in a little bit more detail now, just to try to explain, if you're actually using the template, what to put in each cell, how to fill it out, right? Okay, so let's look at our input revenue tab here. So again, you can select a start month for the model. So we're starting in January of 2024. And here's your unit mix, the square footage for each type of unit, and then again, your annual rent per square foot. This completion month, this is when the construction should be completed for these units. So we're saying in month 17 of the model, so month 17, so it's kind of 17 months after January 1st, 2024, these units will be complete. And then we're saying, hey, in month 18, we'll be able to start renting them out. And then this assumption here is assuming that, hey, it's going to take us 6 months to actually fill all of these units. So it's going to spread out kind of that, the renting of these units out up to your kind of stabilized occupancy rate over 6 months. Now, there's the ability to add in additional revenue per unit per month. So examples could be, maybe you have some parking revenue. These are not probably the most likely to be used for a self-storage, but maybe for other types of commercial properties. But maybe there's some miscellaneous fees. Maybe there's a remote access code or something system that that customers can opt into, and that costs some amount. And so you could say, okay, this is going to be $10 a month, and then when we come down here, we can say, okay, only 25% of our customers here, 25%, are going to opt in to this additional fee. So maybe not everyone pays that, right? So that's the idea with these additional revenue per unit per month. Again, we already hit on the annual rent increase. I want to dig a little more into the vacancy rates here. So this includes credit losses. So if we're starting at a 15% vacancy, going down to 8% vacancy, but that is vacancy as well as the percentage of rent that you just don't collect. So there's going to be some percent that it's just uncollectible, and you have to foreclose on those tenants or, move those tenants out if they're not paying. But there's some that you may just not collect on, right? And so this is kind of your all-in, what are you not getting paid between vacancy and credit losses. Okay, so that's really what you need to know on the revenue side. On the expense side here, a couple of things I wanted to dive into a little bit more. You might have expenses that are one-time expenses. So grand opening marketing is a perfect example. Maybe you want to spend $5,000 when you first open the facility in that first month. So we say that's going to happen on month 15, and it's going to end, the last payment is also going to be on month 15. It means it's only going to happen in 1 month. And then we can say, does this expense repeat each year? We're going to say no, because it's just grand opening expense, right? But there are other expenses that happen one time a year, but they do repeat. So real estate taxes is a good example where we could say, okay, this happens in month 19, and we're saying it's going to be 75 cents per square foot is what we're expecting for our property tax for this particular location, and it is going to repeat each year. And it's going to grow based on these percentages, right? So we can increase those year by year as well. So those are examples of kind of one-time costs. There's also some examples I want to show of, let's say your lawn care, landscaping, maybe snow removal. That's going to be $2,000 per month for the entire property. But you might have some expenses that are better modeled at a per square foot basis. So your building maintenance. Maybe you want to model that on a per square foot basis. Or some examples here, I don't know if we have any set up. Let's say, utilities. We could say maybe there's going to be, we want to model utilities on a per unit basis for some reason. And so we could say it's going to be $10 per storage unit. So that is another example of how you can use this pretty flexible expense model here. And then lastly, you can model expenses as a percentage of revenue. So let's say we have an operations management firm that is going to manage, our property management firm is going to manage the property. We're going to pay them 6% of revenue for that. And then maybe it's that same firm also does some general and admin work for us, maybe accounting, collecting rent, that sort of thing. And they charge us 1% for that. Or maybe we have an outside accountant or bookkeeper to do that, and we want to model that as a percentage of revenue as well. You also have the ability to add in reserve for replacements here. So if you think, hey, we're going to need a new roof every once in a while, and so we want to set aside some reserves for that replacement over time, you can do that here. I'd mentioned you can add in salary positions. I have this set to 0. So the number of this particular employee is 0 because we don't need a facilities manager, because we are hiring this property manager that we're paying a percentage of revenue. So if I decided instead of the property management company, I'm actually going to hire an employee, I would want to put 1 in here for this facilities manager. So now we have 1 employee in here. And then I'd want to come back here and turn this to 0 because we don't want to double count. We don't want to pay both, right? So that's how that can work. And then this, again, all brings us back to our input financing tab, which I've already kind of walked through how this works. But a bit more detail I want to talk about is once we've assumed this $3 million construction loan, we have the ability to add in our financing costs for each loan here. And so you can select what type of debt it is or which loan it is, and then you can apply an expense. So like loan financing costs, I have this set at 2% of the loan amount here, and maybe there's some loan closing and bank charges, appraisals, inspections, that sort of thing. And then when you kind of refinance to mini perm debt, you're going to have closing costs again, appraisals, legal, all that same kind of closing cost again, probably. And then when you finally refinance to permanent debt, again, we're going to have those same similar closing costs. So this allows you to model out kind of each of those expected closing costs for each time you refinance or get a loan. Okay, so going back to our construction budget here, you can see a couple of different ways to model your construction. So you might have certain expenses that are kind of just a total expense, like the land. We're going to have land here for $750,000. But maybe there are certain expenses that you want to model out on a per unit basis. So we could say, here's the hard costs for each unit, and we want this to be, instead of just a total dollar amount, we're going to kind of model this out as a per unit basis. So we said $4,000 on average per unit, and there are 450 units in this facility. So a total of 1.8 million in hard costs there, plus the 750,000 in land. And then you can see some other, maybe some utility installation, parking lot, final grade and sod, all to come up with a total development cost here for us. And you can put in some timing here. So for example, the cost period saying it starts in month 6 and goes through month 12 of the model. That means we're going to be constructing and these costs will be paid kind of spread out evenly over month 6 through 12. And maybe the land doesn't make sense to be spread out, so maybe we want to just put that all in month 1, for example. That's how you can use this construction budget section. The last thing on the construction budget that I want to point out is that you might want to, make some renovations or improvements, at some point in the 10-year life cycle of this model. And so we've set aside, hey, in month 60 here, we're saying in month 60, we're going to have $25,000 worth of renovations and maybe some updated equipment that we need for the property. And so we're going to spend $5,000 on that as well in month 60. So that's the construction budget. Finally, let's go back to our input distributions tab. And just to give you a little more clarity about how this cash reserve section works. So let's say early on, we're trying to save and kind of keep cash within the company because the property is getting stabilized and being rented out. And so we're not distributing cash to investors just yet. And then at some point, the property is stabilized and we say, okay, let's go ahead and start distributing some percentage of our cash. And so we're going to distribute 50% of our cash here to investors. And you can adjust that number, right? And then in year 10, we're going to sell the property. And so 100% then is, once the property is sold, 100% of it is going to be distributed to investors after the outstanding debt is paid. So we'd say based on a 6 cap and our net operating income, we expect gross sale proceeds of 6.1 million, total outstanding debt's 2.7 at this point, and net sale proceeds of 3.4. And then based on all of those assumptions, the distributions and the sale proceeds, we get to see, what is the IRR for this property, as well as cash on cash returns as well. So again, this is a pretty sophisticated model, and there's a lot here. And so again, if you have some questions about how to fill it out, want someone to fill it out for you based on your plans, we can help with that. Or you want our simple self-storage unit model, you can grab that in the description of the video below as well. So there'll be links to this template as well as our simple model. And then finally, as a thank you for sticking around to the end of the video, there is going to be a link to a form that you can go grab a coupon code. So you'll fill out the form and we'll email you a coupon code to get a discount on any of our templates. You can use it on any of our templates as a thank you for watching to the end. So lastly, if you have any questions, support@projectionhub.com is the best way to reach us, or leave a comment in the video comment section below. Thanks so much.